All right, we are live. While we're waiting, y'all, just one more minute. You all will notice that there is a Q&A box in addition to the chat box. When you have questions, which I know you will, make sure to put those in the Q&A box so we can keep track of those and get those answered. We'll have plenty of time for Q&A. All right. Well, let's get started since we are at the top of the hour. Give me just one moment to make sure we are recording. All right, we are so delighted to have you all here. So welcome. My name is Amy Sylvis. For those of you who don't know me, we are broadcasting across several platforms today, including YouTube, LinkedIn, Facebook, and of course here on Zoom. And for those who don't know me, my name is Amy Sylvis. As I said, I am the founder and CEO of Sylvis Capital. We buy large apartment complexes and flex industrial spaces and invite investors to take advantage of our experience, our research, and invest alongside of us without the daily hassles of tenants, termites, and toilets, at the risk of being a little blunt there. And gosh, we have almost 2,700 apartment units now, over $400 million of assets under management. And our goal here at Sylvis Capital is to always provide value and educate so folks can make the best decisions that they can for themselves in the alternative investing space, including real estate. So we are so privileged and honored to have Dr. Peter Linneman with us here today. I suspect he needs no introduction because you all are very informed and up-to-date real estate investors, but I'm just going to do a quick intro for those of you who may not be familiar with him, because you'll see what a privilege this is to have him here. So for over 45 years, Dr. Peter Linneman's unique blend of scholarly rigor and practical business insights have won him accolades from around the world, including PERA's prestigious Glasscamp Award for Real Estate Research, Wharton's Zell-Lurie Real Estate Center Lifetime Achievement Award, Realty Stock Magazine's Special Achievement Award, and the list goes on. And it's no surprise because he received his master's and doctorate in economics under the tutelage of Nobel Prize winners Milton Friedman, Gary Becker, George Stigler, Ted Schultz, and Jim Heckman. And he has a distinguished academic career at both the University of Chicago and the Wharton School of Business at the University of Pennsylvania. And for 35 years, he was a leading member at the Wharton's faculty, serving as the Albert Sussman Professor of Real Estate, Finance, and Public Policy, as well as the founding chairman of the Real Estate Department and director of the prestigious Zell-Lurie Real Estate Center. He's published over 100 scholarly articles, 8 editions of the acclaimed book, The Real Estate Finance and Investments, Risks and Opportunities, and the widely read Linneman Letter Quarterly Report. So his long business career is highlighted by his roles as founding principal of Linneman and Associates, a leading real estate advisory firm and its affiliates. And for nearly 50 years, he has advised leading corporations and investors. So, Dr. Linneman, what an absolute privilege it is to have you here today to join us and bring us up to date on what is going on in the economy, in real estate. There's a lot of data, and we would love for you to help us make sense of it a little bit.
Well, Amy, thank you for having me. There is a lot of data, and a lot of it is being revised as we go, which makes the job much harder.
Yes.
I'm going to focus mostly on the economy. The reason, just to remind people, is if the economy stops growing, the demand for your space is going to stall and maybe even decline. And we are in most markets in an interesting situation where we've gone from a period of notable undersupply to a period of notable oversupply. And we're all counting on the supply pipeline drying up, which it is, and then demand continues and we'll all be all right. But if demand slows too much, and that is to say the economy slows, it will be a hard time even when that supply pipeline starts emptying out. And we're not facing a whole lot of competition, but we're facing competition from say in the apartment space, which Amy, I know you do a lot in, we're facing competition from people staying in their parents' home or taking on an extra roommate, which is one less apartment, etc. So that's why I dwell so much on the economy, and you also do industrial. When the economy does well, people buy more, and when people buy more, they store more. And when I say store, things go through the throughput system, and industrial demand is related. So let's take a quick read on the economy. I like to leave a lot of time for questions.
Great.
Quick read on the economy is the data is murky. The data is particularly murky right now. And I'll take some things we do know, and then I'll go to some things we're not so sure of. We do know manufacturing activity basically has flatlined for 2.5 years since the Fed raised interest rates. Very different than healthcare. Healthcare, if I had a heart attack right now, I'm not going to say, I think I'll wait to see what Powell's interest rate decision is before I go to the hospital. I'm going to go to the hospital, right? Manufacturing is, in contrast, greatly affected. How's it affected? One, most manufacturers finance themselves on lines of credit secured by inventory and receivable on floating rate debt. And so they're very sensitive to the short. And when the Fed jacked up the interest rate, you jacked up the cost of those manufacturers operating, which makes it less attractive for them to supply things. Secondly, a lot of the consumers of manufacturing items borrow short term. And it could be, the most obvious is auto. About 2/3 of all people who buy an automobile take out a loan that is tied to the short-term rate. You could have it in different ways. Auto has absolutely been crushed since the Fed raised interest rate. Healthcare, unfazed. Okay, and you can go another sector, a huge other sector of the economy is state, local, and federal government. Largely, if we need a policeman, we need a policeman. If we have school teachers, we have to have school teachers no matter what Powell says next. So that's not sensitive. Then come to a sector closer to us, construction, development, mostly done with short-term money, floating rate money. The cost of developing homes and apartments and other things has gone up notably as the short rate went up. So the manufacturing and other sectors that are interest rate sensitive, which is probably 20-25% of the economy, have been hurt. 75% of the economy, not terribly affected, but 25% is a lot of the economy. So the interest rate is dragging down that 25%, I think needlessly. We still are below 2010 trends in GDP. We're still below trend employment from the 2010s. Yes, we made up a lot of ground, but obviously the pandemic hit hard, and we're still at the end of a lot of adjustments in that regard. The Fed needs to cut interest rates. I've been saying this for 2 years. I can give you, there are theoretic models, but I'm not going to bore you. I'm going to give you common sense. Since inflation peaked and they had the interest rate at 5.5%, they being the Fed, at 5.5%, they've reduced the interest rate on the short end by 100 basis points, and inflation has fallen by 400 to 450 basis points. What does that mean happened to the real return net of inflation for doing nothing with your money? That is just sitting with it in a bank or sitting in it with treasury notes. Even though they lowered the interest rate, the return is greater than 2 years ago on the short end. Why do I do apartments and all the brain damage? Why do I even do a 10-year treasury with the illiquidity and the risk? I'll just do short term and collect my premium. And that's what people have done. The short rate is way too high. I'll give you another. Inflation is, it depends how you measure it, 2.5%, 2 to 2.5%. If you say the short-term rate should be 75 basis points above that, that says it should be, let me just take a rounded number in the middle, 3%, 3.25%. It's 4.5. That's way too high. It's distortionary. The long rate should be 3.5 to 4. And you've seen, as people believe the Fed's going to cut interest rates, the long rate come down because people rotate out of short into long, bids up the demand for long, and bidding up the demand for long lowers the yield. So you've seen long-term treasury come down. I think it'll come down more as the reality of the interest rates come. How much, I got asked yesterday, what do I think the Fed will do in an hour or so?
Yeah.
And what do I think they should do? I think they're going to cut by 50 basis points, half a percentage point.
Okay.
Simply on what I was saying, if they cut from 4.5 to 4, it's still really high compared to inflation by any normal standard. I wish they'd cut by 100 basis points. There's no chance. I'm not saying they cut to zero. They should. I was complaining when they had the interest rate at zero, and I was complaining when it's high. You don't want apartment rents at zero, and you don't want apartment rents at $1 trillion a month. You try to find that point in between that optimizes. You don't want zero interest rates, and you don't want real high interest rates. You want to find in between. And either too low or too high does damage. It is very interesting to me that the Fed is terrified that if they cut the interest rate by 25 to 50 basis points, they'll get runaway consumer price inflation.
Right. Makes
no sense. Why does it make no sense? For 8 years in the 2010s, the interest rate was basically zero. 8 years in the 2010s, the interest rate was basically zero. What was consumer price inflation during that time? 1.5 to 2%. Now, put away all your nonsense models and just look at the data. And if all you did was look at the data and you said for almost a decade, we kept the interest rate on the short end at basically zero, which did hurt the economy, but we kept the interest rate at zero. And we didn't get runaway inflation. How is cutting the interest rate from 4.5 to 4 going to create runaway inflation? And just from an empirical point of view, just look at the data point of view. Now, there's some reasons I believe that's the case. And I think that's because as they pump money into the system in the 2010s, we didn't get consumer price inflation. We got asset price inflation.
Yes.
And so the money did find a home. So I think the same thing is basically going to happen in the next 5 years. We're not going to get a lot of consumer price inflation, but we're going to get a lot of asset price inflation. And so they are needlessly concerned about consumer price inflation, in my view. So I think they will cut by 50. They should cut by 100. There's a zero chance they'll cut by 100. Having said that, July last year, I said they would cut by 75 to 100 basis points. Last year, everybody thought I was crazy. And then they got some weak data at the end of July. They had some more weak data in August. They cut by 50 in September and twice more. In July this year, it was clear the economy was slowing, and it was clear inflation was way down. And I said, they're going to cut 100 basis points yet in 2025. Everybody thought I was insane. They got weak data in June, and they got weaker data in July.
Right.
They didn't meet in August. And I think you're going to get 50 basis points this month. I think you're going to get 2 more 25 basis point cuts the rest of the year because you're going to get a few more weak data points. Not collapses, but weak data points on the economy. And inflation's going to stay relatively benign. So all that is good for real estate because as money rotates out of short, riskless It tries to find a yield,
Mm-hmm.
naturally tries to find a yield, and it's going to find that in illiquid and risk. And that's what we do. We do illiquid and risk. That's what an apartment is, illiquid and risk. It's what a warehouse is. It's illiquid and risk.
Yes.
Maybe not the highest risk. There's not enough money going to illiquid and risk. Now, it's interesting. I then get asked by people, but what about the stock market? Stock market's really pricey. All you have to do is look at the stock market. A lot of money is going to risk there. Stock market is a very interesting phenomenon right now. If you look at something like the Russell 3000, which is, quote, most of the companies, pricing is not high. It is not high at all. It's high for about 10 to 20 companies that are all in tech. And that is something very different. That is risk, but it's a particular type of risk.
Right.
It's a bet that AI is going to make a jump in the US productivity. So instead of, let's say, averaging 1.5% productivity growth, which is what we've done, they're betting that we're going to average 2.5% to 3% a year. And if that is true, if in the next 10 to 20 years, instead of getting 1.5% growth from productivity, we get 2.5% to 3%, those 20 companies are massively undervalued.
Right. Yeah.
Because people are not all in. They're in, but they're not all in. If it turns out that AI is just the new way we get our 1.5% a year. It was electricity, it was internal combustion, it was highways, it was computers, it was home computers. If it turns out that this is just the new way we get our 1.5%, those stocks are massively overvalued.
Yes.
And only time will tell. I mean, I can have an opinion, but it is not like assets are being massively overvalued. It's like 20 stocks, and they are driving those numbers. The rest of the market not doing terribly well, not doing terribly awful. So you'll see a rotation in. How's the economy doing? It's very interesting if you look at the economy. By the way, people ask me, I got asked a very nice, interesting question the other day. What do I look at when I look at the economy? And the answer is like 100 things. When you look at a Monet painting, big Monet painting, what do you look at? Do you only look at the yellow? Do you only look at the blue? Do you only look at the green or the red? Of course, your eye is attracted to the red strokes and the green strokes and the blue, but the grays, the whites, they all are something you look at. Some are more dramatic. That's the economy. It's a lot of brush strokes. So if you look at Linneman letter, one of the things is we probably have 80 to 100 charts. And people say, well, which ones do you look at? And I say, all of them. I look at all the brush strokes. I try to figure out what they mean. Some are more dramatic than others. Some are bigger than others. Some are dominating in the painting, but you got to look at all the brush strokes. If you looked at all the brush strokes right now and over the last couple of months, economy is not growing as fast. Why? Probably tariffs and tariffs uncertainty. Why tariffs? Rough number, imports are 10% of the economy. Just rough, obviously out your way, little more than that. But on the US as a whole, it's about 10% of the economy. Over the last 7 years, if you had $100 of import, there was about $3 of tariffs on it. Okay? Depended where it came from, it depended what item, but when you simply looked at the total imports and you looked at the total tariffs collected, you collected $3 in tariffs for every $100 of imports. So it was a top line tax of $3. Right now it's running about $17. Okay. If I told you we had that dramatic of increase in the tax rate on any 10% of the economy, any 10% of the economy, I don't care what the slice of 10% would be. Could be construction, could be healthcare, could be whatever. It will slow the economy because taxes distort, taxes slow down, they reduce the incentives to do things, and it causes people to adjust, and adjustments ultimately create growth, but in the short term, they're just brain damage, right? And then you add to it, we don't even know if it's $17. It could be $19, could be $14 on
Right.
whatever, it's going to be higher. So we have a notably slowed economy because we've increased the tax on 10% of our economy by a notable amount. You can argue that's good for other reasons, but you can't argue it doesn't slow the economy, because taxes slow the economy, and particularly top-line taxes slow the economy. Because if you think about top-line revenue taxes, which is what a tariff is, you might be making $1 and they put a $17 tax on top of it. It's tough on top-line taxes are very difficult. As a result, the economy has clearly slowed. If you looked at the crude pattern of the economy over the last couple of months, it's murky. And I'll come back to the data itself in 1 second. On the one hand, it looks like bumps in the road in an economy that grows and keeps growing. Okay. So if you did pattern recognition and you looked at all those brush strokes, but remember, the painting's not done. So if you looked at the pattern of the brush strokes, you'd say, it looks like a painting of heaven, but you put the dark spots in early, okay? Alternatively, that same set of brush strokes looks like we're going to lose 1.5 million jobs in the next 14 months. And it's not a painting of heaven with the dark parts put in first. It's the painting of hell, and there's a whole lot of more dark strokes to come. And right now, it looks the same. And that's why I say, think of a painting. At some point, it could look like we're going to do heaven, and at some point, it could look like hell. And I'm not clear which it's going to be until I see more brush strokes. Okay. What's that mean? I'm more cautious right now than I've been in some time, because I do know the tariffs are slowing, just common sense, they're slowing. I don't know by how much. Therefore, I don't know if this is bounces in a road and we're going to power through it, or this is the beginning of a notable job loss. Yeah. And just think about underwriting today. I think it's about 60% chance it's bumps in the road, and about 40% chance it's the painting of hell, that we're going to lose 1.5 million jobs, but I just don't know which. So I'm being cautious in that regard. I think interest rates are going to come down. It's going to be a nice financing window. But back to our starting point, just when you finally get the supply drying up, you may also see people doubling up with their parents and so forth. I don't think so, but it's very possible. People, and then one other topic is this data revisions, okay? I don't think they're political. I'm not inside the belly of the beast. Yeah. I do know it's disturbing and annoying. For 2 years in a row, the Bureau of Labor Statistics has gone back and looked at their revised numbers. So these were the numbers they had revised during the course of a year, from April through March of each of the last 2 years. And when they went back 3 months after that window had closed, 4 months after that window closed, they came back with about 900,000 fewer. That's after the revisions were made month to month, the second month, the third month. Now, to put that in context, imagine you report that we had 2 million in profits, okay, for each of 2 years. And then about 18 months later, it comes back that no, you really only had 1 million in profit, okay? 2 years in a row. You imagine? 2 million in profit to start with. And the answer comes back, you really only had 1 million 2 years in a row. You may not know what the problem is, but you'd know there's a serious problem in your controls.
Yeah.
You'd know there's a serious problem in your procedures. You may not know how to solve them, but you'd be all over it. That's what worries me, is you've had these very major for 2 years in a row. In addition, the revisions that are occurring are murkier. What do I mean by murkier? If you go back 3 months ago, they reported about 145,000 jobs were added.
Mhm.
And it was odd, and I said so at the time, that only about half of them were in the private sector. We have about 162 million jobs, and only 22 million of them are in state, local government, okay?
Right.
Mostly in education and security. So you go, okay, just back of the envelope, you would assume 22 divided by 162 would be about the share of state and local government growth, right? Some number like 14%. It was half. State and local government was half of the job growth. Well, we had 100, let's call it 150,000, and we had 75,000 in the private sector. That felt odd. And I didn't know what was odd about it. I just knew it felt odd. Well, they then come back, and if we sit here today, they say actually state and local government didn't grow by 75,000. It actually shrunk by about 10,000.
Right.
And in fact, over the last 3 months, state and local government has shrunk by about 25,000, which is odd because state and local government is heavily unionized. And if they were shedding jobs at that rate over a 3-month period, you would expect the unions to be all over the media.
Yeah.
And I don't know about LA, not a whisper here. I've looked at the Chicago papers. I've looked at the Philadelphia, the New York, not a whisper. So I'm not saying the data is wrong. It's odd that you have a big drop in state. It's odd that it was very high, because it's kind of a steady Eddie sector. Then it's really odd that it got reduced from high to negative with no whisper from the unions. Now, maybe it's lagged. Maybe you're going to get inundated. So when I say I don't understand it, I'm just telling you, I don't understand it. So the revisions get larger and they get odder. And I don't know if it's their algorithms. Remember, all this data is sample data. It is, some people say to me, well, they're going to get the real data eventually. No, it's all sample data. What's all we've ever had, that's all we're got. So they clearly have to go inside the machine. And they should have done this several years ago.
Right.
And figure out what's wrong. And retool before it's too late. And I would say 2 years in a row where you have almost 1 million jobs revision downward. Too late. For all we know, the numbers I just talked to you about right now, they get revised up. I don't know, right? Or they get revised down a year from now. So it's very murky. And that also gives me a bit of pause. There are contradictory signals. Retail sales seem to be doing well. Footfall seems to be doing okay. Footfall at retail. Leasing of industrial space seems to be doing okay. Apartment demand seems to be doing okay. Yes, there's too much supply, but the demand continues. So when you kind of piece together the strokes, it's confusing, for lack of a better phrase. And therefore, until I get a bit more brush strokes, I'm a bit cautious. And I'm not traditionally cautious that way. I think that's noteworthy. The last thing I would touch on, and then I'm happy to do whatever you would like, is people say, well, we can't continue the federal debt. We can't continue the federal debt. Now, I'm 74 years old, and my entire life, people have said, we can't continue the federal debt. And you know what? We keep continuing the federal debt.
Right.
You hear this phrase that the deficits are robbing our children and grandchildren. And in one level, it's true. Namely, we're borrowing from our future with the promise to repay it later, right? So we're bringing resources forward in time. That's what you do, by the way, on a building, right? You're bringing the income stream forward in time in a way to allow you to build it or buy it or whatever. So let's examine this. We're robbing our children. If you go back to when I was born, there's nothing magic about that. The United States was a poor country by standards of today, not by standards of then. And you know that because in 1929, we still had like 25% of the population didn't have indoor plumbing. I mean, just to kind of put a face on it. Then we had the Great Depression with 20-some% of the people not working. Then we had World War II where people are dying and we take productive resources and blew them up. That's not adding to the economy. Now, by the way, I'm not saying it shouldn't have been done, but it didn't add to our wealth, right? So you get to when I'm born, which is 1951, we're a pretty poor country. The net household wealth was essentially zero. It wasn't zero, but it was essentially zero.
Wow.
And we had federal debt associated with World War II that we had brought forward. So if I did a balance sheet on the day I was born for the nation, it was zero net household wealth currently, and we owed the future. We had negative net worth when I'm born.
Wow.
We as a nation. Let's fast forward to today. I'll skip to the end. We have $175 trillion. $175 trillion in net household wealth. And we have $25 trillion in federal debt not owned by branches of the federal government. And I take that out because if the government owes itself, it pays itself, it receives it, right? So I'm taking out that. So just for round numbers, we had zero, and today we have 175 trillion. And today we have 25 trillion of federal debt. Now let's do our national balance sheet. It's 175 trillion minus 25 trillion. We have $150 trillion, all created since I was born. That is to say, the bulk of it has been created in my lifetime. Some of it was inherited, but remember, we had zero. We all in my lifetime, 150 trillion has been created by who? Us. Those of us that are living, and in fact, about 80% of it by people over 55. Okay. Just that's the math of it. Now, let's go back to robbing our grandchildren. We're going to give, suppose all of us died today, that 150 trillion net, right? It's the 175 minus the 25, the federal, that all goes to our heirs. Mm-hmm. I think they did okay in spite of the federal debt. My generation, I'm not saying my generation is magic. We inherited nothing. The generations before us inherited nothing. Why do my children and grandchildren deserve to inherit anything? What have the little snots done for us? Okay.
You sound like my mom.
I'm joking. That's right. Your mother's on. I should say that. What have the little snots done for you? No, and I'm joking, obviously. But we are giving the largest net inheritance ever in the history of mankind. We're not robbing our children when we run up the federal debt. We're just taking a little bit of what we were going to give them and reduce it. Now, remember that 175 trillion is not static. It's growing.
It is.
So imagine the 175 trillion growing 3% a year. That's like $6 trillion, just under $6 trillion. We could run $6 trillion in debt, federal debt, every year, and without having any less inheritance to our children. Or another way, if we only increase the federal debt by 2 trillion, but net worth grows by 6 trillion, we left 4 trillion more to the little snots. And we haven't robbed them of anything. It's our money. And when people say we're robbing them, it's like, imagine, I'll personalize it to you. If you said, Mom, you're old, just die. Because if you live, you might travel, you might enjoy yourself, you might give to charity, you might be in a nursing home, and that's reducing my inheritance. I'd hope your mom would cut you out of her inheritance, right? You little snot, right?
Yeah. Yes.
And that's what it is. It really is that, yes, we are using up some of an extraordinary amount that is growing faster than the deficit. So what's relevant is our wealth net growing faster than our deficit? Now, I'm not in favor of deficits. I'm just saying we have the right. We've earned the right. People say, well, how long could we do it? I just told you, we have 150 trillion net worth. That's growing at about 6 trillion a year. And we're increasing federal debt at the rate of $1 trillion or 2 a year. We could do that forever.
Yeah. Interesting.
Ever and ever. Even if our household wealth didn't grow, imagine household wealth didn't grow. How long could we spend $1 trillion in federal deficit more than, and the answer is 150 years.
Right.
The nation is only going to celebrate 250 years of the Declaration next year.
Mm-hmm.
So when I say forever, I mean forever. Now, this is not to say we're spending our money wisely on the deficit. That's a different question. And Milton Friedman used to say that whether we have a surplus or deficit, dumb spending is dumb. So, for example, and I'm not saying this is the case, suppose the federal government decided to pay $1 trillion in bribes. Okay? That's not productive. Whether we have a surplus or a deficit, that's not productive.
Correct.
Focus on, are we spending it productive? On the other hand, imagine that the government could spend $100 million and eliminate all human suffering. What, we're only going to do it if we have a surplus? Of course not.
Right.
If it's that productive, we do it whether we have a surplus or deficit. So the question is not the deficit. We can do it forever given our wealth. We couldn't do it in 1950 because we weren't wealthy, but given our wealth, we can do it. You heard the math. The question is, are we getting our money's worth? Is it more like the bribes, or is it more like solving the problems of mankind? Each program is different. So people overly worry because the debt is stunningly over collateralized by the asset, which is the United States citizenry. So what if I stop there and open it up to you or questions? And
yes,
I think we got about 20 minutes.
Fantastic. Well, thank you. Gosh, that is definitely a take that I hadn't heard before, but the math makes perfect sense. So thank you for elaborating on that. Let's see. So Richard had a question, and just a reminder to you all, this is an incredible opportunity to ask a question to an expert, an economist. You all heard his bio. You've heard just what he's explained to us. So don't miss this opportunity. Y'all put questions in the Q&A box, and we'll take advantage of this brilliant Dr. Linneman's experience here. Richard,
hopefully all the snots didn't hang up.
Yeah. Nope, we didn't see a single person drop. I did get a text from my mom in capital HAHA. So Mama Sylvis found it very, very funny. So we got a laugh out of that. So that's good. That's how we know we're doing our job. Richard Hall asked, these economic and Fed and government policy insights are extremely valuable. But what about from a more consumer and worker-based perspective? What trends are you seeing from the demand side?
So the consumer balance sheet is in pretty good shape. Partly, I was just telling you the 175 trillion of net worth. And yes, most of that is held by the upper 50% of the wealth distribution. That's always been the case.
Right.
When I was 22 and a student putting myself through college, you know what my wealth was? Zero. Thankfully, it's not zero today. And so we forget that part of wealth buildup is over life. It's saving, it's compounding, you become smarter, you become more trusted, and so forth. So the consumer is in pretty good shape. They have larger cash balances than most times in history, not all times. They had higher cash balances when we were in the midst of early COVID, but they have high cash balances. They have jobs. Okay. We don't know how many jobs, but we know they have jobs, right? They have credit card debt, but it's hard to sort out how much credit card debt they really have. You say, how can that be? There's sort of data. The problem is, even old people like me increasingly use credit cards not for debt, but for convenience.
Yes.
And you don't pay any interest on it. It's when I charge, I'm going to pick up some food for tonight on the way home for my wife and myself. I don't view it as debt.
No.
When I use my credit card, I view it as convenience. I'm going to get the bill in 3 weeks. I'm going to pay it with no interest. Yes, I pay for the card, and yes, the merchant pays. And so the cost of my food is higher as a result. And so what's happened over time is the data has gotten harder to interpret how much a credit card debt is really real debt. We know a lot of it is. Like, we know a lot of it. It's just hard to know how much. My gut is, but it's only a gut, based on the trend in using for convenience, not so much more. Are there people in trouble? Yep. Always have been, always will. Most of them are related to me. And I suspect many of you out there have the same feeling. You know, you get the phone call. No, but seriously, the consumer is in pretty good shape. But there has always been part of the consumer in precarious shape. I don't think the number of consumers in precarious shape is notably different than normal, one way or the other. So I'm not trying to say doesn't matter. It's just that's kind of a standard part. Consumers driving okay. Corporate sector, bit more puzzled, right? You're getting hit in manufacturing. You're getting hit if you deal with manufacturing. Travel and leisure still is not fully rebounded.
Right.
You see that in Vegas. Vegas is down over the last year by, what is it, 9% or something. Vegas is going to do all right in the long term, but it's gotten hit. So it's not to say the consumer is spectacular. It's okay. And the questioner is right that that's the main sector you have to really watch.
Right.
Those are important brush strokes. And that's why I watch footfall. That's why I watch retail sales, which came out yesterday, which is pretty strong. Those are important strokes in that, brush strokes in that painting.
Fantastic. Richard, let us know if you have any follow-up questions. Thank you, Dr. Linneman. Mr. Mike Flaherty, my dear friend and fellow USC Trojan. Mike, nice to see you, friend. He has asked, what is your value growth expectation of B and C class multifamily assets over the next 3 to 5 years?
Over the next 3 to 5, unless the C becomes a D, which is a risk. It's always a risk with C's, as they do C minus. They can truly become D's, which just kind of falls off the face of the earth, and it becomes very difficult. If you can keep your C's and your B's and C's, you'll do okay. Multifamily has performed well we've studied 45 years of data. Multifamily performs pretty well. Sometimes the high-end stuff outperforms. Sometimes the low-end stuff outperforms. As listeners know, it's interesting that sometimes the low end, well managed, is the most stable. And that's because you have people who can't really move up to the A's and B pluses, even when the A's and B pluses are hit hard. They don't have good enough credit records to qualify, but they got to live somewhere. And so we own a property in Nowhere, Ohio. That is an A property in the market, but by any objective standard is a solid B to B minus. And what do I mean? We're the only game in town of any scale other than people scrambling around for a onesie and a twosie and a threeplex. And no one's going to build a new one in the market. I wish I could find dozens of those properties.
I bet.
I won't get 100% increase in NOI, but I'll get kind of 3 and a 2 and a 3 because it's people on Social Security and worker people, and the worker's not going to disappear. And yes, I'll have a little downturn, but yes, the people on Social Security and retirement, and so it can do kind of well. I think the real question is you have to keep your properties at that level. The most vulnerable markets for Cs are places like Houston. And the problem is Houston's going to build 3% of the stock a year. Well, you build 3% of the stock a year for 15 years. And that means you basically have half of the stock suddenly a lot better than you because nobody builds Cs. So what was a solid C can find itself really going down quickly because yes, the units get absorbed, but your position on the quality curve gets forced down. That's the opposite of me in Ohio. My apartment will always be what it is. I'm in no risk of being pushed down the quality scale. You get high growth places. Yes, the bodies will come in to occupy it, but you get the risk of worse and worse and worse credit risk and more people skipping out on you and more people doing real damage. That's the danger. That's why I meant if you can keep your C a C, but if you're in Houston, just for example, you have to work a lot harder to keep your property a C than if you're in a low growth market to keep your property a C because you don't have all this great stuff coming up on top of you.
Great point. Really great point. Thanks for the question, Mike. Appreciate it. All right. Richard has a follow-up. Thank you you have time for a couple more questions, Dr. Linneman?
Sure, sure.
Wonderful. Thank you. Richard says oops, that was his old one. Let's see. I think I saw one in the chat here. Richard said, while 100 trillion or so of landed assets is very encouraging, but with boomers living longer and feeling uncertain in their own retirement, might the future inheritance, sorry, this just scrolled real quick. The future inheritance transferees grow increasingly frustrated with their own student and personal debt and AI limiting job opportunities and foment increased civil unrest?
Yeah. It's possible. It's very possible that people get frustrated. I would hope, as a 74-year-old, that they don't get frustrated that I'm alive. And yes, there may be a year or two at the end of my life when everybody finds it frustrating. But in general, I don't think that's a big reality. Look, we know, back to the consumer. Let's tell a dirty secret that we all know. How do young people afford B plus and A apartments in the markets you're in, especially out in California? How do they afford them? And the answer is grandma and grandpa. And it's mom and dad making transfers today. I'm not saying they shouldn't. I'm just saying that's true. And so it's already getting a lot of that transferred. And yes, it's frustrating, but they already are getting a lot of transfers. Who pays for the family vacation to Disney? There's there's a lot of grandparents and parents paying for they want to be around their grandkids and such, right? So they don't necessarily want to be around their kids, but they do want to be around their grandkids, right? And so there's a lot of that transfer occurring on the fly who's paying for a lot of universities, who's paying for a lot of the fancy student housing at universities. And it's mom and dad, but it's also grandma and grandpa. So there's a lot of that transfer occurring. We don't know how much. We really don't have very good data that I've ever seen on how much, but we you know it. So I think I think it's a relatively stable situation. I don't think you're going to get a lot of grandchildren killing their grandparents just to get their inheritance earlier, right? It is interesting that if you go back to the pandemic, you saw this spurt in home ownership, and a very short-lived spurt. And it was due to two things. One, you couldn't buy anything. You couldn't fly to Europe, couldn't go to Vegas. Vegas was shut. Couldn't go to Orlando. It was shut. Couldn't go to the ball game. Couldn't go to the movie. So savings rates shot up, and people suddenly, after like 10 months, had money for a down payment because they couldn't buy any of that. Now, once you could, spending patterns went back to what they were, more or less. And you saw home ownership go back to normal because you need a down payment. But the other source of a lot of those down payments that happened during 2020, 2021 were that people my age died earlier by a year or two because of COVID.
Yeah.
And that has normalized. That's kind of gone away.
Yes.
But there was a spurt of inheritances that gave people, I'm not suggesting they were happy about it. I'm just saying there was a spurt of inheritance, and that's kind of gone by the way.
Right, right. Okay, helpful. So, Dr. Linneman, you mentioned a bit about you're uncertain. You're not typically this cautious, especially when it comes to this economic data. What would you advise investors like myself, those folks attending today, to pay attention to try and get more certainty? Which strokes would you be paying attention to in the painting in the coming year or two?
First of all, one thing I'd advise is, assuming I'm remotely right about interest rates, whereas 6 months ago, 3 months ago, a year and a half ago, I was advising people, be patient on financing. You know, there's a better financing window coming. As the rates come down, there'll be a better financing window. I think that better financing window is sort of here or almost here. And therefore, to the extent you're financing, don't get greedy over the next month or two and take what's there. And yes, you might have done better or might have done worse, but take it and don't get greedy. Second is operationally, particularly in terms of employment and retail sales and unemployment, I'd wait and see what the next 3 months of data show before making any big decisions. And the reason I say that is the data pattern looks like, okay, we're going to be just fine. But it also looks like we could lose 1.5 million jobs. And I'll know better that answer 2 months on, 3 months on. I won't perfectly know the answer, but I'll better know the answer. Because we are kind of at that point that could be an inflection down or a bump in the road that we just power through. And so I don't think you have to wait 20 months. I think waiting 2, 3, 4 months. For example, if you've identified an apartment you want, you've doing the underwriting, if you could keep the deal treading water with an out for another 2 months instead of scrambling to close in a hurry, those 2 months might give you a little more comfort in your underwriting of absorption. Because if in fact the next 2 months of data are notable job losses, that's very different than if the next 2 months are continued growth, but not as high as you'd hope. Right? That's you can't wait forever. but
Right.
2 or 3 months, I think it's not normally the case that 2 or 3 months add a lot of insight. I think we're at one of those moments in time where 2 or 3 months could add a lot of insight.
Right. Especially when things are so murky or maybe in some
Yeah,
cases slightly
exactly.
contradictory. That makes sense.
Exactly.
Makes a lot of sense. Mr. Mike Flaherty is interested in knowing your top 3 multifamily investment markets.
Top 3 multifamily investment markets. I like Charleston.
Okay.
I'm active in Charleston. I like Charleston. Difficult to build, and there's a good amount of demand. I think a lot of it fueled by parents and grandparents, but it's a good market. If I had to take this is not quite your question, but if you said do something contrarian, I'd do Nashville apartments.
Interesting.
And I do Nashville suburban. Nashville has gotten a bad reputation on its apartment market, but it really is more focused on the downtown. And yes, it has a spillover. Nashville has historically been a suburban market. It still is a predominantly suburban market. And I think it's obviously got great growth dynamics. So I would probably do it as a bit contrarian. And then I have to have a third, huh? Where would I pick? I don't know, something like Orlando. Big demand fundamentals. Interestingly, I'm doing an apartment development in Vegas.
Wow.
We're doing an apartment development in Charleston. We're doing an apartment development in suburban Austin. I wouldn't go downtown Austin.
Yeah,
but I do suburban. California, I have a hard time figuring out because communist countries are difficult to evaluate.
Yeah. Mike and I both live here in California. I don't see any circumstance in which I'd ever invest here, but just one lady's personal opinion.
Yeah. Yeah.
All right. Any other questions? Sharon, I think your question, I don't know if this was targeted towards me or Dr. Linneman, but this will be our last one. What is the minimum return you'd like to see on a passive real estate investment? Is that for Dr. Linneman, Sharon, or is that for me? Or we'll pass it over to you. Peter, what do you think?
Well, if it's truly passive and it's stay rich money, right, as opposed to get rich money. If it's get rich money, 12, 13%, right?
Annualized.
If it's stay rich money, you should be very happy with a low leverage and get 7 to 9% over a 5-year annual, over a 5 to 6, 7-year period. That would be my answer. I must say, Amy, I'm disappointed that the usual question I get that leads off is how can you be so damn good looking and brilliant at the same time? And we didn't get that question today. So I'll have to come back again and hopefully get that.
I think I may have missed that. We had a whole bunch of people putting messages.
I'm sure it's there. I'm sure it's just
my ego needs to
know it's there. But you're very kind to have me, and thank you very much, everyone.
Thank you again. What is the best way, Doctor, for folks to get a hold of you? Because I know you have your letter. Maybe they want to subscribe. What would that look like?
Go to Linneman Associates, Linneman Associates. Okay. You'll see all the things we do there. You'll see a connection to some education materials, our book, Linneman letter. You'll see it to speeches I've given in the past. You'll see it to a charity, Save a Mind, Sam Ilimu. You can see the charity that we predominantly support. And you can find out about the wonder of me at Linneman Associates. And if you wanted to reach out, my brother kind of can help on a lot of things, and just do D as in Doug Linneman at linnemansociates.com.
Terrific. We have put that in the chat. Thank you again for your brilliant insights. I know it is such an interesting time, but we've truly received multiple comments saying how grateful people are for your insight. They can't wait to watch the recording, to dive deeper and absorb more. So thank you again for being so generous with your time today.
Thank you for having me. Have a great day, everyone.
Thank you. And if you'd like to get in touch with us, learn more about multifamily hands-off investing, sylviscapital.com/webinar. I put that in the chat as well. Have an amazing day. And the Fed chairman is speaking in a half hour. So don't miss that if y'all are interested in interest rates.